think there's a lot of really good news. Like, obviously, it's a scary time. I think because of AI, it's sharpened minds even further. We're
Okay.
getting things taking place that probably wouldn't have happened without being an AI assisted exploit. So
Hmm.
that is kind of scary. Although I think our view is that whilst we're going through a sort of heightened period, it only takes the attacker one vulnerability that the defender has to draw up everything. But there are really fantastic people working in this security broadly, but specifically crypto and DeFi security, and
Mm.
building lots of great tools. And we love to partner with these guys. We think that it's a period, and the industry is adapting. So I think
Yeah.
there's good news there, right? And then it's really interesting what your interest and love of DeFi. Many of us share that. There's the really it's the degenerate. There's lots of really like crazy / innovative stuff there. There's risky things. There's also super safe stuff that you can do.
Yeah.
And I think one of the things that sometimes people don't even know that Nexus. One of the things that hopefully being on this podcast and live recording with you guys and the audience, there may well be a few people that hadn't heard of Nexus Mutual before, didn't know that you could get cover for these sorts of exploits. That'd be fantastic to broaden the people's awareness.
Yeah.
And also just that a lot of the times, some of the people that knew of Nexus back in the early days, they still, they've heard how, up until some of these bigger, the 2026 exploits were kind of like shock people because everyone generally thought smart contracts had been battle tested, they were Lindy, and that, the risks were getting less. They brought, our data confirms broadly it is getting less risky. It is just sometimes out incidents, and you've got to have a risk management. But there are plenty of things out there too where on a risk adjusted basis, and that's the important bit, it isn't the headline yield, it's the risk adjusted yield. And proxy, you could go and use a rating agency. S&P are stepping into the space now. There's crypto native ratings companies that are doing things on stable coins or DeFi protocols. Those could be things. You can do your own research. You can look at the Nexus Mutual cost of coverage, and if that's greater than the yield that you're going to generate on whatever you're doing, question it at least, right? But there are we point out now there are plenty of things that we cover that are way cheaper than anyone ever thought it would be. So just as a little example, dealing with a really exciting new fund, an RAA out in the US, and they do a lot of Uniswap liquidity provisioning. And I told them they could buy cover from us for about 25 basis points of notional. I was really happy because they were like, wow, that's great. We didn't think it could be that cheap. Whereas often the refrain I can have from some others sometimes is just like expectations that things are too expensive. And that's one of the challenges that we've been working with as a team for years and years. But we always find ways to engineer, like work and structure with our friends and partners, and as well as retail, some products that give them coverage across like not just one protocol, but a whole series.
Yeah.
It might actually be worth me saying what the coverage is, right? Because we've got a good 2/3 of the way in to the recording here, without me mentioning specifically what exactly it is we cover. So maybe we should
Absolutely.
do
Please.
that. So like, because I mentioned the genesis around like the DAO hacker, that was a smart contract exploit. So it's the kind of thing where as opposed to a traditional finance counterparty, when you're deploying capital into DeFi, it's the code primarily that you're relying on. So at its core, Nexus is kind of one of those early innovators against smart contract risk. Right? So it's to do a lot with the code, although we also deal with some economic-based risks, and I can unpack that. What we aren't doing, for instance, is it's good to give account. Sometimes people will say, "Hey, can you insure my Bitcoin against price volatility?" And to that extent, that's a market price based risk. And to that extent, it's like, well, that isn't what we could, but it's not really like not our strength. Like, go to a market maker on the price of Bitcoin, and that'll protect you if there's a lot of volatility in the market price. That those products already exist. We've been carving out and innovating new ones that have been there before. So we have this thing called protocol cover, and whilst it at its base is the smart contract, sometimes people think that's all it is. It's quite a significantly more than that. Matters now because of the changing nature of the threat landscape and the types of exploits that are taking place. But then layered on top of the smart contract risk, we have something called against Oracle risk and Oracle manipulation. So now, in DeFi, it really matters where you're getting your pricing info and other like sources of info from the real world. And that's broadly what oracles do. And so we provide this coverage here. And it's happened on numerous occasions now that it's not necessarily the smart contract code itself, it's the oracles. As we move into a world where RWAs become real world assets, become more and more of like the yield generation of DeFi, it really matters. We just had a recent issue on Hyperliquid. I'll plug the Nexus Mutual blog. Go to the Nexus Mutual blog. Maybe we can provide a link after the like some notes to the show here. And we recently published about like the exploit that happened on Hyperliquid and how that was essentially an Oracle failure, and how if we had listed it and provided the cover, we didn't at the time, but essentially like the terms that we provide would mean that we would provide coverage where we don't think necessarily would. And then on top of the Oracle manipulation, it can be governance attacks. Those don't necessarily get as much in the news, but I was in ECC earlier this year, and I met a guy working specifically on protecting teams from those sorts of governance issues.
Yeah, quite an extreme governance hack just happened with Bonk, right? With the Treasury.
Yeah. And then so it still happens. Like, it kind of can go away for a couple of years, and then boom, it's like massive event can occur. And then alongside this is where we stray into like economic less than the pure code. It's what we call bad debt severe liquidation, which is to do with like the way that a lending borrowing protocol will liquidate people when it as the market is impaired. So that's exactly what happened with Aave. Whilst it had nothing to do directly with the layer 0 DVN and the impact it had to Keltdow with their ETH, because RSETH was an accepted asset in Aave, and the way that things are pooled was having a knock-on impact on Aave markets. We saw this with more. They're not the only ones. We saw some stuff late last year with Morpho and other platforms, and so you get this bad debt impairment, and so we cover for that risk too. And then when you factor all those, I'm doing a plug here, but when you factor all those things in at the price that we can do it at, then I think when the sophisticated investors they go, wow, okay, that's really pretty cool, because it takes away all this crypto idiosyncratic risk that they do need to have a handle on as a risk manager, but they might not be able to. Otherwise, without us, they wouldn't have a way to offload it, and it allows them then to focus in more finely on the risks that they do want to take, because you always have to take risk. The idea that you earn yield without taking any risk, it's not possible, like breaking the physics of finance.
Yeah.
But it's the risks that you do want to take versus those that you're not comfortable with. So hopefully that's a good exposition there for the audience.